first thing that someone's going to ask you is, well, how do you get paid? Nobody does anything for free.
It's nice to say 0% financing for, 12 to 24 months. No financials at all. But what it is no doubt there's a fee. So there's no free money and there's a fee associated with it.
How long does it take to get approved for the credit card?
It takes less than 2 weeks. And there's not a fee to apply. So you can apply.
Another important thing is there's no prepayment penalties on these, correct?
Absolutely.
Explain what a DSCR loan is, because that's a pretty important feature that a lot of people don't know.
Debt service coverage ratio. Kind of a mouthful of words, isn't it? We want to make sure the money coming in is more than the money going out by at least 15%. Your first bridge loan or a DSCR, and the second, the capital stack. We stack on top, and that's the beautiful butter that makes it all work.
That's a real fancy way of saying DSCR.
At some point in the process, you may hate me. You may really dislike me a lot, but
this is possible.
Today, I have two mortgage goats. I guess you can't both be goats, can you?
Sure, I'll defer to Eric. Absolutely.
John Smith with us.
I was talking with John the other day, and he has something that's really unique that I don't see very often, but I get a lot of calls from realtors, investors, and that sort of thing. And I thought it could really help some people by bringing this out there. So, John, you explained like capital stacking and USFs and all that kind of stuff. So just take it from the top, kind of with what you told me the other day, especially with that capital stacking thing, and just lay it out for us. And we'll ask questions as we go.
Capital stacking is an unsecured business line of credit or credit card, which a credit card basically is an unsecured line of credit. So that's what the capital stacking is. And what I'm doing now with my company, Mint Street Capital, is we are able to provide people opportunity to get a unsecured, like I said, like a credit card, unsecured credit. And you do not have to, which is the big thing, you do not have to have any financials, no W-2s, no pay stubs, no tax returns, no profit and loss statement. You do have to be at work with people that are businesses, companies. This can be even an LLC. It can even be a brand new LLC. A person can just get an LLC. In fact, I advise that. Go get an LLC, and 2 weeks later, they can have that, have the EIN number, open a bank account, and then you can apply for, again, my capital stacking or unsecured business funding. And we're not going to ask for any financials. It's going to be mainly based on your personal credit profile, but it helps you then establish business credit as well too. But initially, we're going to look at it based on your credit profile. You don't have to have a stellar credit score. And I know we'll probably digging more into that a little bit later instead of giving all the features on it.
Before we dive back in, don't forget to smash that subscribe button and ring that notification bell so you never miss a beat. Let's get back to the video.
But that's kind of it. It's a line of credit available to new business owners with, a solid credit score, but no financials needed. And I guess the big part too, 0% financing, 0%.
I was just going to say, everybody hears credit card and they start freaking out. So, I really wanted to point that out, that it's a 0% for what, 12 to 24 months?
It depends on what you get approved for, but you'll either get approved for 12, 18, or 24 months. And if you do get approved for 12 or 18, we have a strategy in place to extend that an additional 6 or 12 months to make it ideally a scenario of 24 months, 0% financing, 0%.
What I really found interesting in it is kind of the stacking portion of it, where let's just say someone is an investor and they're wanting to buy a fix and flip.
Yep.
And correct me if I'm wrong, but you can go get an 80% first mortgage, that 20% unsecured line on the second, including renovation cost and all of that, and basically be able to buy this house with 0% interest down for 12, 18, 24 months. Okay. The first thing that someone's going to ask you is, well, how do you get paid? Nobody does anything for free.
Right.
So lay that out, because I think that's really intricate how it works.
A lot of people, Eric, say, what's the catch? How do you get anything out of it? So let's be right up front with it. It's nice to say 0% financing for 12 to 24 months. No financials at all. 680 credit score and above at least gets you in the door to talk about it, and 0%, as I said. But what it is no doubt there's a fee. So there's no free money, and there's a fee associated with it. The fee is 9.9% technically. I like to just say, let's call it 10%, even though the charge will actually be 9.9%. Just makes it easier for numbers. Just call it 10%. So if we get you $100,000 line of unsecured capital stacking, that's what I like to call it, capital stack. We get you $100,000 capital stacking. It's a $10,000 fee. Now that's where sometimes people go, $10,000 fee, you got me, John.
Right.
I didn't know that, but like I said, when it's 0% interest on this, 0% for, again, we up to 24 months kind of scenario here, that's cheap money. That's cheap money. Anybody that really does the math or pauses for a moment realizes that's cheap money, especially for business credit scenario.
When you first explained it to me, I had that exact reaction. I was like, oh. And then I sat down and did the math. And if you took that $100,000 and you kept it for 24 months, it basically works out to be 5% per year.
5% APR.
Yep. You know, and that is you can't even come close to that.
No.
You know, not when these guys are out here calling me for, you know, hard money loans that it's, you know, triple that, sometimes even a little bit higher. Right. So at first the shock is like, oh, but then you're like, oh, wait. Now, one thing that I found really important to make sure that you point out on your side too, is that fee is charged right up front on the balance, on the limit that you have. So if you get a $100,000 limit, it's basically 10 grand. Correct. So if somebody says, "Oh, I'm only going to need 20," that's only $2,000. I got to make sure they account for that in there too. Okay.
Correct.
Right?
So if a $100,000 line, we're going to charge, it's not out of your pocket, that 10 grand. We're going to apply it to the line. So you have a $90,000 balance.
So if you go and buy one of these fix and flips and you take the 80%, including renovation cost, and you've got that other 20%, basically the only money that somebody would have to come out of pocket if they were capped out at the full 100% would be the cost of that fee.
And that fee's not even out of pocket. You're right.
Yeah.
Correct. If you don't mind, Eric, I actually kind of bullet pointed down kind of a scenario that I thought would be helpful to go over some numbers. Is that cool?
Yeah.
Is that cool?
Absolutely.
So ultimately, let's talk about that. So what it is a scenario, absolutely, where you can buy a property, and ideally a fix and flip, which I've done, fix and flip for nothing out of your pocket. And of course, that's where John, a fix and flip, we know to buy those properties, you got to put 20% or 25%. You got to put a big chunk of money down. Well, this is not the trick, but this is just the know-how. This is what we're talking about here, is what we've dug up, is what's going on inside. So let's do some numbers. Purchase price, $250,000. So we found the property, let's say $250,000. We like this property. Great. This is going to be the one. We see, it's got to make sense money-wise, right? We're going to buy it at the right price, $250,000. We also look around. We got $75,000 of renovation, right? So $75,000 of renovation to do this property, this fix and flip scenario. So we're $325,000 into it. Okay. Now, what we're going to do is you used a word, Eric, you used the word mortgage. And me also being in the mortgage industry for 23 years, now more on the commercial side of things, we don't use the word mortgage is tied to kind of residential, but right. It's good for people that are watching this podcast and listening to get an idea of mortgage. So we'll kind of use some terms there. So a lot of times, first and a second mortgage, we've heard of 80-20s, right? The old 80-20s, get a 80% first mortgage, 20% second mortgage. That's 100% financing. Well, it's kind of like that basically. So we'll get what we call a bridge loan, or we could even do a DSCR loan on the first mortgage. And so 80%, I guess I didn't jot down that number. What do we got there for 200? What am I talking about? 250,000 purchase price. 20% is 50 grand. So we're going to do a loan amount for 200,000, right? So we got a loan amount, but we got 50 grand out of our pocket. And then we got the renovation costs, as I said, 75,000. So we're $125,000 out of pocket on this property, this fix and flip that we want to buy. And if we've done our research correctly for buying a fix and flip, we want to have some money left over after, right? So before, of course, we commence on the property, we want to make sure with this renovation, are we going to have an aftermarket value? Let's call it $400,000. Cool? $400,000. So buying at $250,000, the house, $75,000 of renovations. We're in it at $325,000 when we're done. This should sell at $400,000 aftermarket. But as I said, we're still $50,000 for the down payment and $75,000 for the renovation. That is out of pocket unless we got capital stacking. And that's why I call it capital stacking. So we're stacking it on top of that first mortgage. that first loan, that first mortgage, if you will, and it's that second mortgage. Because what it's going to do is that capital stacking, or that unsecured business funding, is we're going to take the cash from that line we have, and we're going to use the 50 grand off of that as our down payments, our $50,000 down payment. And we're also going to use the $75,000 from that capital stacking as our renovation costs. So here we're doing the down payment, the whole project, with these two loans. One, your first bridge loan or a DSCR, and the second, the capital stack. We stack on top, and that's the beautiful butter that makes it all work.
Now, just for some people out there, I mean, we know kind of what the lingo is and stuff. Explain what a DSCR loan is, because that's a pretty important feature that a lot of people don't know.
It's a great question. DSCR, debt service coverage ratio. And yeah, it's a kind of a mouthful of words, isn't it? Debt service coverage ratio. If you really pause and kind of slow it down, it explains it. Debt service coverage being the biggest one, ratio. What they're going to do is they're going to look at that property, Eric. Let's say you're the buyer of that scenario we just went through. Okay, Eric, you found the property, $250, needs $75,000 of renovations. You know, Bob's already told you his agent is going to have an aftermarket value of $400,000. This is a good buy, Eric. You got both those loans going on and set. We'll do a first. I then, as the investor financing on it, get you the first one on a DSCR. Again, I don't need your tax returns. I don't need your pay stubs. I don't want your stuff. I don't want your W-2s. I don't want your profit and loss statement from your business. I don't want any of that. But I am going to say, Eric, do you have Eric LLC? Oh, John, I do. I got an LLC, got an established LLC. Got a bank account on attached to it. I do. Great. Excellent. Get back to your question, is we're just going to check if this property, once you have it done, on a DSCR though, is more of a holding kind of loan.
Mm-hmm.
We want to make sure the money coming in is more than the money going out by at least 15%.
Yeah, the term that I always use to kind of just say is that the house has to stand for itself. It's got to be able to cash flow. As long as that's there, that's a real fancy way of saying DSCR.
I should have said that, Eric.
It's
more money
easier.
coming in than coming out by 15%. Yep. It's got to stand on its own. That's a great way to put it.
The house has to stand on its own. So tell me how, when you set these loans up, and we're going to stick with this fix and flip right now, and then I'm going to talk about a different scenario that I thought about even after we talked the other day that I thought was just amazing. Walk us through the scenario of during the construction process of this, what kind of money you have to pay out, how the payments work, that sort of thing. So somebody can make sure that when they're figuring this, it's something that's really going to work for them.
So when we were talking about that first and second mortgage, the second mortgage, again, I'm using words like residential, I know, but that second capital stacking will go on top of either a DSCR type of loan or a bridge loan.
Right.
A bridge, it's a little bit, the word bridge is used differently than a residential world. But because a bridge loan is going to only be like a 12-month financing scenario where it's a fixed for 1 year, it's interest only that you pay. It's going to be tied to prime, while the DSR loan is a 30-year fixed loan.
So one thing that I thought was really interesting is that first mortgage isn't far off of where, the current regular mortgages are, and significantly cheaper than what the hard money loans are. You said that they were sometimes running on interest rates between like 8 and 11%.
Correct.
Okay. Which is not that far off of traditional financing, and it's a great intermediary between the hard money and the conventional stuff that we've been used to for years. So somebody that doesn't quite fit in one or the other real well, it's a great way to kind of bring that gap together.
And that's going to be the bridge loan where it's going to be 8 to 11%.
Yep.
The DSR loan is going to give you a better interest rate that's a bit more competitive, maybe 1% higher than what your quote unquote competitive rate these days on your full documentation, 10%
Right.
down, whatever scenario. So it's still, again, we're not going to ask for financials or tax returns or W-2s or any of that stuff on either of those programs. But to get your question, that's what I jotted down. So it's like a construction loan. So it's going to be a lot like a construction loan is. And I get, you may know what that means, Eric. I know what that means. Bob may know what that means. But a construction loan, whenever I had people call me and say, hey, I want to get a construction loan as a loan officer lender doing residential and stuff like that, the construction loan, I always use this funny little phrase just to set expectations. And I think it'll help here on this podcast. And I always say, great, we'd go through the whole thing. But at some point I would say, at some point in this process, doing this construction loan, it's a very, very different type of mortgage than what you've traditionally just got an end loan. And then you just got it, we've closed, done. Construction loans, there's a process associated with it. So at some point in the process, you may hate me. You may really dislike me a lot. But my goal is to pull it back around in which you then like me by the end. And the reason why is because there's more moving parts. So even on this type of loan, they still have to get a contractor. They're not just going to be able to buy a house, Eric, say, okay, John, let's get to the closing table. I'll put my 20% down. I'll take it off from my capital stacking line you've given me. And then I can just do whatever I want with the house, this and this. Nope. When we're doing it on a fix and flip, and we're going to know the property has disrepair issues, and fix and flip, we're going to need a contractor, and we're going to need a contractor's breakdown of estimate of cost and material. Right. And then we're also going to send out an inspector to inspect on the house during the process while it's gone, because a person, which is good to know, a person does have to front these dollars. Now they can pull it again off their stacking, but then they front these dollars. So yeah, you're going to pull the money off your capital stacking line that you have. Okay. You're going to buy the $20,000 of windows or windows and doors, $25,000 of windows and doors, and put those in. Match what the contractor gave you. Our inspector's going to come out, take a look, said, yep, they're all the size, they're all put in, they're all the brand we said, and everyone's accounted for. Great. You're going to front that $25,000, and then we're going to reimburse you for it, which is then just, yes, you do have some dollars up front, but again, you pull those off this line that you have, and then we'll reimburse you for it. So in the end, it's nothing out of your pocket, but it's similar to a construction loan.
Yeah, but it sure beats having to put that 15 to 20% down. And then I've always found when I've done those fix and flips that I'm the one fronting the money even after putting the 20% down.
Yeah.
Because they do that. It's the exact same process. So it really kind of can get into your cash flow. You can't have too many of these things going, or you can really severely kind of limit yourself. This is a great way to kind of bridge that gap and make sure that you can keep those deals going.
When you said that, so is it possible to do more than one of these at a time?
Yes, you could do, because that line isn't tied to that property. So that it's an unsecured, again, it's unsecured.
So
that
can you get more than one of the unsecured lines?
Yes, you can get on that first kind of loan you're talking about. Yes, you can. You can get multiple. Yeah,
so I think what Bob was saying is, can you have
buy 3, 4, 5 properties?
Yeah, can you have an 80% first and like an 80-20 on 5 different properties? But I think what he's saying is you can go get an unsecured line for 300,000.
200,000 is the max, but yeah.
Okay, 200,000, and that can cover 2 or 3 different properties.
Yeah.
And then just do that DSCR on the first ones on multiple properties.
So a great way to think of it is, think of me as your rich dad. Okay, you're rich
Nice.
dad, rich uncle. I'm your rich uncle. So I'm your rich uncle or rich brother. Okay, think of it in that way. And my point is, I have the money. I have the line, I have it to my disposal, and I say, hey, my rich uncle wants to give you the money to help you buy that house. So when you buy that house and you go, I bought the house, I've identified the house, but I'm going to need a 20% rich uncle. Great. Here you go. Off the rich uncle of the line. Oh, it's going to need $75,000 renovations. Okay, well, do the renovations. And when I see the renovations are done, you go, I did the windows and doors, and it's done. I go, okay, I'm going to go inspect. Okay, looks good. All right, cost you 25 grand. All right, here's 25 grand. Does that help bring that together? Because that's what it is. You're just leveraging. The rich uncle in this case, though, is you. You have the unsecured credit now. You have this line of credit available to you that, yes, you can work on it, multiple properties. So maybe you need maybe you need 2 lines of credit, Bob, for $400,000 instead of just one, because a maximum is 200,000. But yes, you can do it on multiple properties.
What about timing? How much time does something like this take?
Awesome question. Since we cut through we don't have a financial piece of it. We pull the credit and then you go get your contractor out there. So this can be 3 to 4 weeks.
3 to 4 weeks. Because I think that would
funding.
be, I guess, until you do it once, you don't really know. I mean, 3 to 4 weeks, that's a good number.
And a lot of that's dependent on title work and that sort of thing, right?
Yeah, we got to get title work. You got to get a contractor out there. You got to submit his bid of what you're doing. Your contractor alone is going to take you 2 weeks. It could take you a week, especially if you're doing properties, but it can be done relatively quick. I wouldn't want to set an expectation faster than 3 weeks at this point. If a person really had it down and was humming through these, then yeah, it could be faster possibly.
So then your payments, you pay the payments on the 80% portion as you're going through. Is that interest only, or is it amortized? You said it's 30-year fixed.
If you do the DSCR, it's a 30-year fix, correct? 30-year
Okay.
fix with principal and interest payment.
And then the 0% on the unsecured portion of it, there's still a payment that's required.
Correct. Even though it's 0%. So like I said, in the example we used, let's use 200. So you got a $200,000 line. The fee was $20,000.
Mhm.
$18,900, 9.9, we're going to call it 20. So 20,000, you have $180,000 available. If you don't identify a property right away, you're going through the process. My point is you still have to make a payment, even though it's 0% financing, 0% financing for either 12, 18, or 24 months, whatever you get approved for. It's 0% financing, but you still have to make a payment. So if you don't use it, you're still going to have to make a $200 payment on that loan. 1% of the balance, and it goes 100% towards the principal. So instead of owing $20,000, now you owe $19,800 because you do have to make a 1% on it because there's no interest. No interest is accruing on that thing.
And I think that's really important because you're paying that down and you recover all those funds when you sell that property.
It's a no-brainer. It's absolutely no-brainer. Said if the fee was gone, I can't even believe the thundering sound out here of like, come get your free money. But there is a fee associated with it. So you want to be in a situation where you're ready to use it. A lot of businesses are ready to use it because they can use that capital stacking. They don't have to even get to first. I know we're talking about the fix and flip, but you can just get the capital stacking alone. I can qualify people. A lot of people do it. Call me. I need equipment, John. I need growth. Add an agent that just send me his business plan. This is a business plan, no collateral, no nothing. It's pretty much, this is what I want to do in the real estate world. And he sent it to me and we submitted his application. Now, his scenario, he had a credit challenge. I'm not saying his name. He had a bankruptcy 5 years ago. And we do have a certain expectation of a credit because that's one of the few things we're qualifying you on. So
Yeah, and it's unsecured. So
yeah,
it's
you
all
better
your
bring a
credit.
pretty fair credit. Now, again, I don't want to say strong, like needs to be a 780. Technically, 680 is the line, but even we will entertain 660, 670s, but you have to have a depth of your credit, and you can't have a bankruptcy 5 years ago.
When you were saying the payment, you don't make a payment if you don't take a draw on it, though, right?
Correct, but the fee that's associated with it, I
draw.
think that's going to be your immediate draw because you're not paying it out of pocket. So
you pay that fee whether you take the money or not.
once you correct, once you
Approved.
agree to say I take that credit card and have it available to me, that's your fee. Correct.
How long does it take to get approved for the credit card?
It takes probably less than 2 weeks, 10 days maybe.
So if you're going to do this, you really kind of have to have something pretty much identified and ready to roll.
With a 30 to 40 day window on it.
Yeah, and if
Say you're going to close in 2 weeks.
Well, I mean, you could and get that thing going, but I mean, if you had 3 or 4 of these properties that you're wanting to do in the next 24 months, you pay one fee, and you could basically roll it through 3 or 4 properties. I mean, that's
correct.
Huge.
That's correct. That's
and
correct.
Then the rest of the 1% is only paid on the money that you actually take. So if you had $100,000 on there this month, you'd owe $1,000. If you had 70,000, it'd be $700.
Yes.
So it's a sliding scale on there. You just have to remember that fee gets added on there day one. But your first deal could basically pay for the fee, and then every deal after that, straight profit.
And once you get offered, you're like, okay, this is what you applied for, and you qualified for 150,000. I'm going to use rounder numbers. I'm at 150,000. It's a $15,000 fee. You have 30 days to accept that. So you already know, okay, I don't need to take it right now, but I got 30 days to either I won't take it at the end of the 30 days, or I will take it in that 30-day time. But after 30 days, your credit's expired and it goes back to the drawing board. You could certainly 30 days later, we'd resubmit, and there's not a fee to apply. So you can apply. I've had people apply and just say, they said, John, yeah, it looks good. I got 150,000, dude. I'm pretty excited. But I just really wanted to see if I could do it. So now at this point, I'm going to kind of get my ducks in a row and I'm going to do this. But I haven't pulled the trigger yet on it, John, but they told me I have 30 days. I'm like, yep, you got 30 days.
What about location? Like, are you limited by
Nope.
dates or?
Across the United States, my friend. Call them in Hawaii. Call them in Utah. Ready to do it. Michigan. Let's go, Bob.
Lake house.
Yeah, there you
Lake
go.
house is in Michigan. Let's go.
I'd rather have a beach house in Florida. Shit.
And then another important thing is there's no prepayment penalties on these, correct?
There's no prepayment penalty. There's no prepayment penalty on any of those. No.
And that leads us over into the next thing that I was thinking about. If you were to buy these properties and rather than taking them as a fix and flip, let's say that you're using that BRRRR method everybody talks about, that buy, renovate, so you could buy a property, renovate it, get it ready for rental, wait that 6 months, refinance it on future value and put it on permanent financing.
100%. The DSCR is a permanent financing, or you could go get your own financing and get a more
Right.
traditional residential financing style, and get whatever your 1.5% less going more competitive rate. Absolutely.
The DSCR, you said that's more towards the 10 or 11%, or what did you say the rate on that is? Or you said
It's usually around 1% more, you said, right?
Yeah, the DSCR is only about 1% more, Bob. Yeah, because it's a fixed 30-year fix. Still, no financials are needed on the DSCR. Well, we already know. So yeah, so it's about 1% more than your quote unquote today's competitive rate. The bridge loan is going to be more in that 9 to 11% range.
okay.
Yeah.
So if you're
And the
figuring
bridge
out
loan
the
is-
numbers on holding a property, you'd figure it just around 1% or maybe 1.5% over what today's rate is. If
Oh,
that
please,
sounds-
please. I do have to take something back. The DSCR loan, I apologize. The DSCR loan does have a prepayment penalty, and it's a doozy
Okay.
of them. So shame on me for missing. The bridge loan does not. The DSCR does have a prepayment penalty, and it's a doozy of a prepayment penalty. Now, again, it's not the capital stacking. It's that first mortgage that we've been kind of talking about, whether you
Yeah.
get a bridge
Okay.
loan as the first or the DSCR as a first. So that's what the DSCR does have a prepayment penalty, and here it is. It's a doozy. 5-year prepayment penalty.
Ooh.
5% year 1, 4% year 2, 3% 3, 2, 1. Steps down 5, 4, 3, 2, 1. So nobody's refinancing that DSCR for at least probably 3 to 4 years. Or what I would do is if a person contacted me, I'd do the bridge loan. I'd say I'd do a bridge loan. It's interest only. It's going to be fixed for 1 year, even if as next year the Fed cuts, this is your rate, and it's going to be fixed for a year, and it's interest only. And then and my point is, let's do your property, let's flip it, or let's get it, whatever, and then let's refinance it, like you said, Eric, into a more traditional style loan, or we can flip it into a DSCR loan at that time if your financial situation with still taxes, whatever, John, my income, I had a big write-off. Great, let's get you at least into a 30-year fix scenario, and we're going to be 1% higher than kind of a competitive scenario.
Is there a limit on those loans, those 2 loans?
A limit how many you can get? No, you could get 50.
Limit
of those.
on price or the amount?
No, I don't believe there is, because we're not working in conventional loan limit stuff. So
Yeah.
no.
I've never seen one.
You've never seen one?
I've never seen a limit on the DSCRs or the bridge loans and that sort of thing. Now, and one thing too that we got to kind of get over is every time, and a lot of realtors are probably going to watch this, is that the bridge loan he's talking about is not a normal bridge loan. This is not bridging 2 properties together and all that kind of stuff. So they need to make sure that they're not mixing that term up.
Because bridge loan residential is a different type of loan than what I'm talking about, this bridge loan investment / commercial scenario. But it doesn't have to be a commercial property. It can be a commercial property. You can fix and flip a commercial property if you want. I'll do that. But you can also fix and flip a residential. Just can't be a primary residence. Somebody can't say, I don't have an LLC in primary residence, and I'm going to say, contact Eric.
And I want to make sure that everybody understands that, because I get people that call me all the time and says, oh, I'm a business owner. And then I look at their tax returns and all they are is just they're self-employed. And there's a difference between being a business owner and being self-employed, especially in your world. The business owner means you actually have a business, an LLC, an S Corp, something that's officially filed to make sure. And that's exactly what you need, correct?
Yes. We're not going to ask you on those papers too to send your articles of organization or your EIN letter, or we're not going to ask that. And we're going to check and make, we could check and see you got an LLC or an S, whatever your business. That's it. We just want to see that it exists.
And to incorporate something in Kentucky, just so everybody knows, is about $40 in about 24 hours. So it's not hard. I mean, if anybody ever needs the state website, I can give it to you. The SOS website, as they call it. Super simple to do.
And I even use a source, which, I'm not getting any affiliate or nothing, but I just think they're a great source. I personally use them. Inc Authority, INC Authority, Inc Authority. That's where I've done. They charge me about $400, and man, they do everything. They sent me a binder with all the stuff. Man, it was really cool. They do everything and set all up and then sent me my EIN number and got it all approved. And maybe I paid too much. I don't know, $400 seemed like a fair deal. And the customer service was awesome. So
Yeah.
I thought
No, it's definitely worth it. I've done it both ways, and I've used Ink before too. And I'm telling you, it's well worth the money for them to do that.
I used a CPA that cost me $2,500 on my first one.
Yeah, man, this is all great stuff. There's so many different ways you could utilize this that after we talked the other day, I sat down and ran about 25 different scenarios, and I was like, man, this is really incredible.
But I want to address again that prepayment penalty scenario, and because that's what something was. It's like, why? What? Because that's why right now, especially knowing interest rates, I don't want to say knowing. I hate to say that. Been in the business too long to say anything guarantee or definitive. But the idea is that interest rates are going to be lower in 24 and 25. Why get you in a DSCR loan today at 8.75%? And with locked with a prepayment penalty that you're basically handcuffed to for the next 3 to 4 years. So I would tell a person, let's do the bridge loan. There's no prepayment penalty of that. Just pay interest only on the money. And then have that for 12 months. Let's use the capital stacking on top of it to be your working capital to do the project. And at the end, you can refinance with my DSCR if we need to, or if you go, hey, I got now things kind of in place, or my wife got this, or I don't know, whatever, go get a traditional residential loan on that, man.
I just backed myself out of the conversation when I was talking to him, and I'm like, I'm gonna have to get these guys together.
Well, and something I thought about too, Bob, is there isn't any limit on that first mortgage, but if you're trying to do them together with that $200,000 limit on that unsecured,
That would give you a limit.
that would give you a limit,
But
$1 million.
I think you guys covered it really well. I want to throw a curveball here because yesterday at my mastermind, what came up was, and this is totally different than what we're talking about, was real estate agents getting paid on mortgages.
Yes.
Yeah.
And John, I know that was something close to you. Is it still close to your heart?
Still is. Absolutely. 100%. Real estate agents are doing the work. Don't they deserve to get paid? That's my point.
A brokerage owner, she owns 3 brokerages, and she had been approached with this. And I told her my experience that, I see it, but my very first reaction was, the last thing I need is distractions, in my space, right? Like the very last thing, I don't mind having other sources of income, but the distractions, that's immediately how it hit me. But I know things evolved over the last year or so, or are they still the same? Or I know you explained it to me once, John, about how it's possible. And it was like all of a sudden it was like coming back. It was flooding back to me. I was like, okay, I'm going to talk to John about this tomorrow.
They relaxed some of the rules on everything over the last 18 months, for sure.
Agents are already doing the work. Why don't they deserve to get paid? And the answer is absolutely. My feeling is that they absolutely do deserve to get paid. And the thing is, way I illustrate my point is top producing loan officers, and this is what real estate agents don't understand. Top producing loan officers, man, they're not touching those files. They have a team touching those files. Really high producing, top performing loan officers, they're really working more towards their strengths. So they have a team. And what I'm getting at is an agent, if they get licensed, they can plug into that same team. Now for compliance and RESPA wise and all that, they have to do depending upon, what company, they do have to do a handful of things. But I'll say even at my peak with my team, man, I was having the initial conversation with the client, which agents are having already, right? Agents are already having those initial conversations. How you doing? How's your finances? This and this, what price range you're thinking about buying in? They're already having those initial conversations. And then the team takes over from there. My team took over from there. Once I got that initial information, might even shared my link that they applied online. They apply online with their link. My team would pull the credit, run preliminary DULP, AUS, whatever needs to be done, Gus. And then they would send them the letter and documentation. The client would get a list of documentation that they could upload. My point is an agent can plug right into that system. So in terms of your question of distraction, where's the distraction? The agent is still doing the things, and they have to do some compliance pieces. At least the company that I'm aligned with, they have to have that initial conversation, which again is conversations that agents are already having. They have to share their link That's the application link. They're sharing an application link just as I'm doing as a loan officer. And they have to then schedule the close. Well, aren't agents already scheduling the close? They're already doing that. It's far from a distraction and it's way overdue, brother.
What about, so you're saying on the agent's own file, they can be the loan officer and the real estate agent on the same file?
100%, 100%.
And there's been
100%.
some companies that'll draw a line in the sand that says, hey, listen, we don't want to get into that gray area. We just rather not pay you on the loans that they're not involved in. But if they've got another one, they could get paid on that one.
Yeah.
So it kind of comes down to, it's pretty new waters from what I'm hearing, and everybody's kind of had their own interpretation. It's kind of like watching the news today. You can hear two stories from two different sides and it sounds totally different. So until they kind of set it out there and get it set, it kind of comes down to the company that you're wanting to deal with and what's going on in that. And this is a conversation we could have for an hour over this stuff, but it's definitely coming. It's coming. Yeah.
Absolutely.
You thought so for a while. How long?
That I thought this was coming. I don't know. For a couple of years. I guess I've been waving the flag for about 3 years.
The first time I told Eric, he said you were nuts.
Yeah.
He thought I was nuts.
Not trying to like start anything.
No,
everybody did.
But what it did is it sent me down that rabbit hole of, oh, I'm gonna go check this out. And the more I started digging into it, the more I was like, wow, okay, this is possible.
I would love to pull up a few Facebook messages or text messages that I've got. When I get them, I'm always like, man. And I did it a couple times at first and it really didn't get the response I hope. But my point is, from agents that I talked to about this X amount of months or years ago, and they told me to jump in a lake. They said I was an idiot. You know, this is ridiculous. You're everything illegal, this, that, but I would never do it. Ethic, impact. And then they've contacted me 18 months ago. Could you tell me a little bit more? Because I just signed up for my class.
Yeah.
My loan officer class.
Exactly.
Or, I want to get signed up for the loan officer class. Could you tell me again, how long is it going to take me to get my class done? And when could I get my first check then? When does that happen again? And you go like, a year ago, 18 months ago, you told me I was an idiot. The agents are already doing the work. I mean, I could really dig into what I do. And I believe this. The agent's doing the work. The loan officer is this. I mean, I'm sorry, Eric, but I believe this.
No, I'm telling you. I mean,
the loan officer is saying, Bob, Agent Bob, could you please put something right here? Please. It'll help me feed my family and pay my bills. I think you're a swell guy. Boy, those are good looking glasses. Are those new glasses, Bob? Man, you're a good looking guy with those glasses. I really think you're swell. I think you're okay, but I don't know. So, but I'm going to tell you you're swell. So I think you're swell. And by the way, if you could just put your next buyer right here in my hand, that'd be great. And you know what I'm going to do, Bob? I'm going to give him a great rate, competitive, good rate. I'm going to give you solid communication, and it's going to be a smooth transaction. That's what I'm going to do for you. And if it really is a nice, big loan by the chance, I'm going to take you. You like Panera Bread? Who doesn't like Panera Bread? I'm going to get you a Panera Bread. Now, not a full Panera Bread, just a half sandwich, half soup kind of thing. I mean, let's not get crazy. But, buddy, you got a half sandwich and a cup of soup on me, pal. Come on. That's what loan officers do. Or I'll pay for your the thing is,
most of the top loan officers would rather deal with an agent that's really involved with their clients and actually goes that extra step, because it makes our job so much easier. I would gladly pay all day long to have an agent involved. Not the ones that said, here's a guy, they scratch the phone number down and go, can you get this guy a loan? And you call them up and they're like, yeah, we don't have a job. That kind of stuff.
And the objection that you're going to get, and I don't want to, because I'm really passionate about the objection you're going to get is going, oh, what you just said, Eric, is that agents, boy, we need them just to do the real estate part of it right. For crying out loud, they have issues and challenges with that. I don't want to add a whole nother thing of having to do loans. You don't do the loans. Our team does. I'm a top producing loan officer. I don't do my loans. I hand it off to my team. I have the initial conversation. I cultivate the relationships. I bring those parts of it in. I bring the business in, and then my team does. Why? Because they're processing jobs. Does my client need me to look over their buyer's pay stubs? No, I got Eric. He can do it, man. He can do it probably 10 times better than me. And he knows, we can send it through this or that. I go, yeah, that's a great idea. He's crunching that out. So my point is, an agent plugs into the team. They're not having to actually do those things. Now they have to, they have to meet then doing certain activities to be eligible for a commission check. And the things, at least that I've been a part of the companies that are doing it, is they have to have that initial conversation, which agents are already having that initial conversation. They're already having that conversation. They have to share their link. And at least the companies we have, then when people sign up, we hire them, they get licensed, they have to get licensed, they hire them. And then there's an employee of it. They get their link. They share their link with the client. They fill it out. It goes to our team. Our team takes the ball, pulls the credit, runs AUS, and takes it from there and issues the letter. And then gives the portal to upload the documentation from the client right to the team. Agents aren't involved in that, but we do require the agent to do one more piece and say, where are we closing at? And are you going to then review the settlement statement? I say settlement statement. Look how old I am. The CD, the CD, CD. Yes. Which agents already do that work?
Anyway, now
They already do that
there
work
are
anyway.
those
Shouldn't they get
pieces.
paid? I think agents should get paid. They're already doing the work. Go get licensed, get paid. It seems insane to me. Any agent that doesn't have their mortgage license as well too. You are missing out on a lot of money.
Okay, I like that presentation better than the last one. Like, I could feel that one a little, that one hit me a little harder. Do you have any other advice? Any other advice for agents besides the mortgage thing? Come on,
Get
man.
licensed.
You run into problems with agents, don't you?
Oh my gosh, Bob, do you really want me to go down that road?
Yeah.
Okay. I mean, it's great because I am a licensed agent as well too. I'm dual licensed. So I'm dual licensed. And the reason why I got dual license is because I was generating referrals from my lead sources, and being in the business 20 years, people know you're in the business and they contact me once in a while first. And they say, John, hey, who should I talk to about selling my house or getting going? I want to looking to buy. I was doing that pretty frequently. And the reciprocation was next to nothing. And so I said, I'll get licensed and I'll say referral fee, 25, 30% referral fee. And I've been doing that pretty successfully every year where I get a 1099. So my point is, why can't agents do the same thing? They can. They just have to get licensed. You have to get licensed. If that's an obstacle, it's hard for me to swallow that pill. Dude, if you went through the real estate licensing, which was much harder than the mortgage licensing process, in my opinion, you could pick up $1,000, at least for us, and I'll be transparent about it, 50 basis points. $200,000 loan, you're going to make $1,000. $1,000, you're not going to get your license. You're going to miss on that $1,000. Woo! That's tough for me. So, I don't know. There's so many things. It's interesting. I was in a real estate meeting the other day, and they were talking about, and the person was talking about if there's changes on from the final CD, you're going to have a 3-day delay in your closing. Because we were in a group and it was some authority that was speaking this in the office. I had to just bite my tongue, and it was driving me nuts because that's not true. And they were saying, so if there's a walkthrough, they were talking about, so on a walkthrough of the house is an issue and then you need to cure it by doing some credit or another. If you have to do that, that will cause a delay, and that cause a 3-day delay. Oh, it won't cause a 3-day delay. There's only 3 things that cause a 3-day delay. Is if a change in the APR is more than an 1/8 than what was disclosed on the final disclosure. If a prepayment penalty all of a sudden magically appears, or if the program changes from a 30-year fix to 7-year ARM. And those last 2 things never happen. And the first thing only happens 1 out of 100 times, maybe. Agents have so much opportunity from, if you said, was there one thing? Don't be so close-minded about your real estate business. It is such a bigger world than just buyers and sellers. Yes. Your license has so much value, and you are in a perpetual life learning university thing, man, with your real estate license. So even if it's not going well right now, even if there's just not some sales happening, man, double down on education, because it is just an awesome opportunity to have a lifelong education that has opportunity, but leverage that. Leverage it. Don't just wrap your arms around it. Share it with others and leverage it. Leverage it with opportunities that we start off talking about, fix and flips. How can you make money without anybody? How can you make money? Can you get a DSCR loan? Can you get a bridge loan with no financials? Can you apply? Can you go get your LLC today? Go get your LLC. That's a great thing to kind of finalize this, man. I've always known the importance of personal credit. This is a great little mini speech. I've always known the importance of personal credit being as a loan officer. Personal credit, having the strongest personal credit you can. It hit me like a ton of bricks when somebody's like, how's your business credit? But I don't have a business. I don't have a business. What do you mean business credit? Real estate agents, you are a walking, talking business. You are a $200 or $400 fee away of getting an LLC and going and starting a business bank account once you get your EIN number. Once you get that, you can start establishing your own credit as a business, as a personal and a business. I didn't realize the importance. Now I'm like, gosh, I can't believe I realized how important it was as personal. I was a fool for not doing this. And what I mean is once you establish that and you get these lines and you accumulate them, even if there's a fee, whatever, and you start building that up, you are becoming your own bank. You hear what I said? I mean, to me, when somebody said to me, so I stole that, become your own bank. You need money? Go to the bank of Bob Sophiea. I need money? I'm going to go to the bank of John Smith. Eric needs money? He can go to the bank of Eric. Make your own bank with your business account. Build those lines up, build your business credit, and then you won't have to go to the bank anymore and carry all your tax returns and profit and loss.
With the business credit, you're saying, so there's a business credit score. Where does that show up?
It's Duns and Bradstreet. So then if a person wants to go get, hey, I won $1 million, they're going to pull your Duns and Bradstreet credit score. It goes from 1 to 100. It goes 1 to 100. So 80 is very good. A 20 is bad on Duns.
With your real estate license, people are calling you and you're coming up with deals and sending them out to agents. Where are those deals coming from? Your database is one, right? People you've done business with in the past. Do you get any business from those Facebook groups that you run? Does that convert any business, or is it just for networking?
Initially, Bob, I set it up to be that, but I wanted it a slow drip. And I would encourage anybody else, real estate agent, do it to say, if you got an area, man, get a Facebook group and start. It was the beauty of it Lake Fent really didn't have. And so my point is I started a Facebook group. Man, it's a lot in there now. I think it's 1,000 people, and some people might say that's not a ton. It's a lot for that group, and it's pretty stinking active. And what I get to is, it was always a slow drip thing for me. I didn't want to come out guns ablaze going, hey, I'm a real estate agent. Use me for your whatever. And so it was my plan to establish this, grow it, put content, gain that trust, have that, and then start dripping after a year. But that was the idea. That was the idea, is to grow that into something, because it's super valuable. And if I start dropping real estate stuff on there, I've already built that know, like, and trust, and showing up at the local lodge, and it's good stuff.
Yes, we
have a great talk.
Yeah.
Become your own bank. We're funding for entrepreneurs.
Become your own bank.
Your own bank. Become your own bank. Isn't that cool? I'd love to take credit for that. Somebody else said it to me. Become your own bank. I went, what? He said, yeah, that's the idea, John. What we're doing when people get this unsecured, because you can just get the unsecured. You don't have to get the first and the second. Get the unsecured, put in place. I have this, and we can get it qualified and just stack it on top. It's a line of credit. It's a line of credit for you in the form of a credit card, business credit card.
With that, you say business. So say I have the best business credit score. A great business credit score. Established business, been around. Is that what they judge that in the personal credit? They're looking at both of those.
That and the personal credit. We don't even look at the business credit initially. Just the personal credit. We want to see depth. So if a person really said, because I've had people that apply that have had like 740 credit score and they didn't qualify for anything. And their scenario is they had very limited, they may not had a mortgage, maybe a younger person that still had a 720 credit score. They didn't have a mortgage. They've had a car payment that they just turned in, and now it's a lease. And they have 2 credit cards, and one has a $5,000 limit with a $4,000 balance, and the other one has a $1,000 limit with an $800 balance. So they don't have capacity, and they get turned down. What they really want to see is people with mature depth of credit. They want to see people who have $30,000 credit card with a $5,000 balance, another credit card with $20,000 limit with $5,000 balance. This is a person they're saying has great score, because they look at your credit cards mostly. They're giving you a business credit card, and they're saying this guy can handle $100,000 or $70,000 or $50,000, 30 and 20 of credit card debt, and he doesn't max it out, and he's only running at 15% capacity on those. We could probably give him a line for $100,000. And it doesn't go on your personal credit. That's great to say too. It doesn't go on your personal credit. You get qualified for I got the 100, 150 a person got. It doesn't go on your personal credit. So on that capital stacking, it's your business credit. We're establishing and building. And then once you use it and don't abuse it, and I like to say that word, you use it, don't abuse it. Yes, you use it, do the fix and flip, pay it off. Boom. Now I want to do it again. You know what we're going to say, Bob? I'm glad we got you 150. You used it and you didn't abuse it. Would you like 300? it grows exponentially. Business credit is amazing. It grows exponentially so quickly when you use it and don't abuse it. And we can grow it and then get you into a situation where you got $500,000 plus on a line. And that's when you become your own bank. You don't need to go to the bank anymore.